Hey guys, welcome to the channel and welcome back to another video. Now, on this video, guys, we're going to be talking about the S&P 500 and sort of giving you guys a little bit of warning or something to think about when it comes to investing in the S&P 500. That's why I titled it Urgent, because I think this is something that all investors need to be paying attention to and need to be thinking about if you are liking and wanting to be and enjoying just investing in the S&P 500. The question, is it becoming too risky, right? This is investing risk that you need to know as an average everyday investor, okay? Now, that's what we're going to be focusing on. I'm going to hit on a few other things on this live, guys. I'm going to talk about the S&P, the good, but I'm going to talk about the bad, right? And then I want to give you just a few risks that you need to be aware of in the market right now. So, and I also want to talk about some alternative strategies to just investing in the S&P 500. There's other ways to get good exposure to a lot of parts of the market without all putting all your eggs in one basket called the S&P 500. So, and like I said, we'll talk about some other market risk and everything as well. Just trying to help you guys understand and make sense of what's happening in the investment world and maybe in your own investments in plain language. If you're a beginner, if you're an intermediate, if you're seasoned, this live is going to give you some things to think about. Please share this link to this live if you're on YouTube. If you're not on YouTube, and I may share my screen a few times, you may want to come over to YouTube at Smart Money Bro on YouTube, check it out. But if you're new here, please consider subscribing to the channel. And everyone, as you come in, hit that like button real quick for me, right? Also, check out the description box below, and there's free stuff in there, and there's ways to contact me in the description box below. And if as you come in, do me a favor, let me know what city you're coming from. I always like to ask that, guys. The next was are here early. Sit 17. Let's see. I'm here. Grayman's here. Good. It's my number one performing investment. Boom, boom, boom. Philly suburbs in the house. Mrs. Moore, glad to have you. Thank you so much. Is from Atlanta. Ohio. Art of War. Good to have you back in here as well. What's up, everyone? Checking in from Boynton Beach, Florida. RC, good to have you. Haven't had a chance to say Boynton Beach in a while. Steve from East Texas, good to have you as well. State College in Pennsylvania. Is that called Penn State, Kathy? Kathy's here as well. Raymond Scott's from Dallas, the DFW area. San Antonio, the River Walk down there is in the house. Kimmy, good to have you. Gavoto, not sure how to pronounce it, from all the way from Portugal. Good to have you. Gatineau, Quebec is here. Dwayne is from Rockford, Illinois. Silent S. I got your email. Thanks, Dwayne. Rockford, Illinois. Chicago's in the house. Kenny, good to have you. Jackson, Mississippi. I think that's the capital. Mississippi is here as well. Montgomery is here. Montgomery, Alabama. Frida, I think it's Frida from St. Louis. Thank you for subscribing. I appreciate that, Frida. Let's see here. Got somebody checking in from Velvet from New Jersey. Good to have you here, Valencia. Happy Valley. What is that in California, Kathy? Oh, Happy Valley. Kathy just told me that's Happy Valley. Pennsylvania. Yeah, Happy Valley. All right. San Diego's in the house. Whoa, but it's beautiful out there right now. We got somebody from Pocono Mountains in Pennsylvania. Good to have you here, Joseph. Thank you so much for showing up. Let's jump into it, guys. And as you come in, hit the like button for me. Just smash it. And I'm going to try to do this and not talk fast. Keep it in very, very plain language, because everybody is not a guru to the stock market. Some folks are new to the stock market. Some folks have been, investing for 20 years. Now, the statistics say that there's a ton of new investors in the stock market in the last 5 to 10 years. That means we got a lot of new people in the investment world, in the stock market. So I'm going to try to keep this as a high level, and I'm not going to dig too deep in the weeds, keep it high level, but we want to have the conversation on why the S&P 500 may be more riskier than you think it is. And there are some really clear-cut risk that people don't talk about when they look at the S&P 500. And we'll go over some of those, guys, as we jump into it. So let's see here. Zanzibar, Tanzania. Good to have you here as well. And Frida, appreciate you saying that, Kimmy. Okay, the S&P 500. Let's just clear it up. Standard and Poor, right? Or it's just a stock market index tracking the stock performance of the 500 of the largest companies listed on the stock exchanges in the United States. This is publicly traded companies, right? We know there's a lot of private companies as well that are not a part of the S&P. These are publicly traded companies, the 500 largest in America. They're set into a bucket called the S&P 500. And actually right now I think the S&P 500 is made up of, I think there's 503 or 504 stocks that are in this big bucket, right? And these are in the bucket. These are stocks that are the 500 largest company by market capitalization, right? It includes the 30 companies that are on the in the Dow Jones as well. So, but there's some examples of the S&P 500 out there, right? I think you got an example of some buckets of stocks, right? Russell 3000 is a bucket of stocks. That's the cap. That's a weighted index of the all 3,000 or so, or a little over 3,000 companies that are in the market itself. NASDAQ 100 is an index, a bucket of stocks, right? S&P 500 is a example of a bucket of stocks, right? I don't know if we got any QQQ people in here, right? But if you are a Vanguard person and you have a bucket of stocks called the S&P 500, you would own the ticker symbol VOO, right? Call it VOO, right? So not to go into too much detail or go into too much background about what ETFs are, what index funds are, just know that the S&P 500 is a bucket of the 500 largest stocks, largest companies by market cap in America. Market cap being the total value of the company's outstanding shares, uh, multiplied by how many okay, let me say that differently, right? I'm looking at reading something else that I have up here in the screen. I got East St. Louis, and I'm trying to talk at the same time. Bronx, Ortega, good to have you here. Glad to see that you're here. I appreciate you being here. South Carolina's here as well. Austin. All right, let me get focused. Market cap, right? Market capitalization is basically the outstanding shares multiplied by the number or the actual price of a stock. The price of a stock multiplied by how many outstanding shares there are. So that's market capitalization. The largest companies are stuck in this bucket called the S&P 500. Now, there's other ways that I'm not going to dig too deep in at all about how companies have to meet a certain amount of criteria to be in the S&P 500, right? US based company of positive earnings, have traded a minimum certain, I think it's 200 or 250,000 shares in the last 6 months. There's ways that companies, there's criteria other than just largest market cap, right? There's a few other criteria that we don't really talk about, so I'm not going to focus on those, right? So why do people say you should be in the S&P 500? There's a clear-cut reason besides the fact that Warren Buffett came out, right, and says in many interviews, he comes out and he says, well, I've already instructed the people that when I pass away, just take the money and put it into a good S&P 500 index fund. So everybody said, whoa, S&P 500. Warren Buffett said that, right? There's other reasons, right? Why people say invest in an S&P 500. By the way, guys, if you're in the chat, let me know. Just give me a yes, no. Do you own the S&P 500? Let me know in the chat below. Thanks, Dwayne, for the thumbs up. Let me know in the chat below, guys, if you are invested in the S&P 500. And I know we got folks over on here from LinkedIn. We got folks on here from Instagram. We got folks on here from X or Twitter. So we got them from a number of places, guys. Just give me a yes, yes, or no, no if you don't, if you're invested in the S&P or not. Looks like most people, right? We got yes, 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 yes. Everybody, look, most people are in the S&P 500 just by way of the chat, right? So everybody's there. Here's why everybody has floated towards the S&P 500. Some reasons, right? The first and obvious reason is that these are stocks of the 500 largest and strongest companies in the US. Strongest, right? And so many people are attracted to the S&P 500 and because hey, I only have to research and learn and know just one index fund. That's all I have to follow, right? And I still own a stake in the 500 largest companies in America. Woohoo! Yeah, we're hyped up. Yes, I don't have to do much at all, right? The other reason everybody loves the S&P 500 is because of the diversification, right? Because each S&P 500 index, it contains, whether you buy it wherever you buy it at and whatever ticker symbols you use, wherever you buy it contains 500 companies, right? That's diversification, right? From various industries, right? And so there's your diversification that people know is very, very important, right? And an S&P 500 is really, guys, and most people know this that are on the chat here, it's really considered, conventional wisdom considers it as about as close to a guarantee of a positive long-term return that you can get in the stock market. So for most people, they see it as very, very low risk, right? To be in the if you there was a study done by, I think it's Cressmont or something like that. They examined the S&P 500 on a rolling 20-year total, to find out how many of those 20-year periods resulted in positive gains. That means they took 20 years from 1930, 20 years from 1931, 20 years from 1932, and so on and so forth. 20 years from 1967, 20 years from 1980. They examined all of those returns on the rolling 20 years to find out how many of those actually resulted in a positive 20-year gain for the S&P. Here's what they found. This is the beauty, and this is why everybody loves the S&P, the S&P, the S&P, because they found that in every single year that they examined, the S&P 500 on a 20-year span, it's you couldn't it there were positive total returns. In other words, if you had invested in the S&P 500 index fund at any point in history and simply held it for 20 years, you'd have made money. You would not lose money. Now, that does not guarantee obviously future returns are going to be positive, right? But the odds of buying and holding the S&P and seeing a gain in your money is good, right? The other thing about the S&P, everybody loves it's great. Whoa, S&P, 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 right? Get that on the t-shirt. The S&P, as I said a little bit earlier, it requires very little effort on your part. You ain't got to do much. You just set it and forget it and go about your day, and you ain't got to watch it every single moment. See what this is. You don't care if the video's up or down. You don't care if Eli Lilly is up or down, Procter and Gamble, Broadcom. You don't care about all that because you got 500 companies in a bucket. You're not tripping on one of them going crazy, right? So these are the reasons people love the S&P, but I want to give you some reasons why you need to be cautious when it comes to the S&P. Here are some problems that I think you need to know as an investor, right? It's anytime you're dealing with money and investing, there are risks. And oftentimes with the S&P 500, people just don't talk about the risk, right? They talk about all the good, all the wonderful, but they just don't go in and say, "Hey, wait a minute. Think about this." Right? There's some things you got to think about, right? So just let's just talk about some of the reasons why you need to be cautious, right? And this is why I said, hey, this video is urgent because we need to really have a different conversation about the S&P 500. And it's probably a conversation that most people haven't been exposed to or haven't did the research on, right? Or sort of overlooked it. But is the S&P becoming too risky? These are investment risks that you need to know as an investor. Number one is this: when it comes to the S&P, guys, there's no customization, right? If you want a hands-on approach where you can pick and pick different stocks because, hey, you heard or read something about that, you looked at these financials and you really want to get involved with this stock because you see some growth that you don't think other people see, but you see it, right? You can't do that when it comes to the S&P 500. It doesn't give you any wiggle room or any way to customize what you throw in the bucket, right? All the stocks in the bucket are automatically chosen for you, right? And that's a problem for a lot of people, right? A lot of people. Let me see what we got in the chat real quick here. I'm just running through, guys, just being nosy. Okay, don't forget, guys, smash the like button for me, by the way. Don't forget to hit the like button. And thank you for subscribing. If you're a new subscriber, you're a new person here. I appreciate it. So again, let's keep it rolling. I won't go too deep in chat because it's not scrolling yet, but that's all right. It'll scroll in a bit. So if there's something you don't want to own, if there's a company you don't want to own in that bucket called the S&P, you can't get rid of it. You're stuck with the top 500, whether you like them or you don't like them. Another problem with the S&P is and a lot of people hate this, okay? And some people hate it, some people are okay with it. But the S&P is not designed to beat the stock market. It's just not designed to outperform the overall market, right? The S&P 500, like any index, it's designed to mirror or follow the market, right? Which means it can only earn average returns. You're not going to say, I'm in the S&P, but I got and the overall market got 12% last year, but I got 25%. No, that doesn't happen, right? It only gets average returns. So of course, with lower risk, right, comes a lower reward. So some people think this is cool, right? This is cool because the trade-off is worth it for all the ease of investing in the stock market or in the stock market itself. I can just get an S&P. It's too easy. So they're okay with saying, okay, we don't have to beat the market. Let's just let's just mirror the market, right? Now, here's one problem with the S&P, and this is pretty much the main problem, in my opinion. I say main problem, but it's the biggest problem that goes overlooked. Okay. And it's probably it's really the reason I'm doing this video specifically about the S&P 500 becoming too risky. And it's this reason right here, guys. And it's the reason you got to be super cautious. The S&P 500 is a weighted index fund. In other words, the S&P 500 at this point right now, and it's trending in this direction, the S&P 500 just may be too top heavy right now. Let me kind of dig a little bit deeper. Okay, so we said the S&P 500 is a weighted index, means that the larger the market capitalization, the more weight that company has in the bucket. It's the more weight the company is going to carry. So let me just liken it to this. Let me think here. Okay, so think about you have a bucket of, let's say a bucket of fruit. You have a bucket of fruit. Imagine having a bucket of fruit, and in that bucket of fruit, which the fruit represents, each of the fruits represent a company, but the bucket represents the S&P 500, right? In that bucket, you had different pieces of fruit. You got a little orange, you got a little lemon, you might have a nice robust apple, you might have a banana, you might have, let's say, a watermelon, you might have a cantaloupe, you might even have like what's the Halloween, the big pumpkin, all in this bucket, one big bucket. Each fruit in the bucket is a company. But the reason I say that the illustration for it being weighted is that the company that the watermelon and the pumpkin represents is going to weigh the bucket down, right? But the company that's represented by the little bitty lemon, right, or the little raisin or grape, right, that's not going to weigh. That's going to be neither here nor there. This is what I mean. So the S&P is weighted by market cap. So the watermelon is Microsoft. Huge, very heavy, carries a lot of weight. The pumpkin is maybe Apple. No, we're not going to make Apple the apple, right? In this scenario, this illustration, we're going to make the big old pumpkin the company called Apple. The cantaloupe might be NVIDIA, right? So this is what you get when you're talking ETFs. Bigger market cap, the heavier the actual company is in the bucket. And right now, you only have a few companies that are really making up a huge, more than normal weight of the bucket. The top 10 companies in the S&P, let me see if I can find that article. Top 10 companies in the S&P make up around 33% of the value of the S&P. Right? So I think the S&P might be, several trillion, 6, 7, 8 trillion, but the largest 10 companies at the top, they're really weighing this thing heavy. And so as they go, the S&P goes. And if you just look at the S&P 500 today, not even by weight, but just look at it by weight by sector, the tech sector makes up a little bit over 30% of the value of the S&P. So you got these really top heavy companies and you have this really top heavy sector called tech IT. And my question to you is the S&P 500 becoming too risky because it's losing its bit of that? Now, don't get me wrong. It's always been top heavy, right? Because it's always been a weighted index, but it's more top heavy now. So the top 10 largest US companies account for 33% of the S&P, and that's above the 27% that the top 10 companies back in 2000 represented. So back in 2000, when we had that tech bubble, I think it was around 26, 27% of the S&P 500 was wrapped up in the 10 companies. And those were 10 different companies, by the way, right? So you as an investor who may have, which most people in here have some S&P 500, you need to know this. This is information that you need to know about your S&P 500 index fund that you have. But even at 33% of the S&P concentrated on those companies, that could be a problem. I'm not saying it is a problem. I'm not going to say things are going to go crazy. I'm not saying any of that. I'm just saying you need to be thinking about this as an investor, right? So this current top heavy concentration has really what's been fueling some of these large gains we've seen in the stock market in the last 5 or 6 months, right? So think about it like this. Let me give this stat. Let me see if I can pull it up real quick. Where's that? There it is right here. The S&P 500 has generated an annualized return of 16% over the past 5 years, right? Oh, and compare that with 10% over the last 30 years. So the top 10 companies have really boosted us beyond the normal. So let's just pull this up. Let me just, if I can, guys, let me actually share my screen if that's okay with you guys in the chat, if you don't mind. Let's see if I can share my screen real quick. I want to pull up and just take a look at these top companies. And this for some of you, this is very, very a very elementary look at the stock market, right? But for other people, this is important, right? Because everybody's not super seasoned when it comes to the stock market, right? So let me share my screen real quick with you guys and see if I can actually pull this up. And if you're not on YouTube, I don't think you can see the screen. But let's see here. Where's it at? Boop, boop, boop. There it is right there. All right. So, and I'll go ahead and hide myself. Let me get a little further in the background. I don't want to be that far up. Keep my face way in the background there, right? All right. So, okay, let's go up here. Let's see if we got top companies. Where are they at? Right here. Oh, here they are right here. Top 25 companies by index weight. Okay. And the top 7 is what we call the Mag 7, right? Mag 7. And we know that the Mag 7 recently we had Tesla jump out of the Mag 7. So this is as of a couple of weeks ago. I think this is April, a couple of weeks ago. So Microsoft, 7% of the S&P 500 is wrapped up into one company called Microsoft, right? If you take the top 3 companies, that's almost 20%. So Microsoft, Apple, and NVIDIA, they make up nearly 10, 17, about 18 to 19% is wrapped up in just those 3 companies. If one of those companies goes down, goes bad, it's going to have a large effect on your S&P 500 index or ETF, right? 4th is Amazon. Then, of course, Meta is Facebook. Google is number 6. And then Berkshire Hathaway has recently replaced. What happened to Tesla? Tesla dropped to 14. Tesla was in the Mag 7. It's dropped out, right? Because it's gone down in the last, 3 months? So that's our top 7 right now. Berkshire Hathaway just jumped up in there. Then you got Eli Whitney, JP Morgan, Broadcom, huge companies, ExxonMobil, right? Huge companies, right? The other important thing, and even Home Depot is right there at 18, which is pretty high, right? And if you look at how it drops off when you get past, say, number 10, right? It drops off from being 1.4% of the market share down to, by the time you get to number 20, it's only at 0.75% of the market share. There's Costco, there's Chevron, Salesforce, Bank BOA is right there. There's Netflix, right? And then up here, guys, which I think is really important for you to know about your S&P 500, is to look how heavy it is in terms of tech. Tech has really been carrying your S&P 500, S&P 500 index fund or ETF over the last few years, right? 30% is wrapped up into that one sector called IT. That's huge. Financials and healthcare are right there as well. If you add in just those three sectors, that is 54%, 55% of the entire stock market is wrapped up into three different sectors only. Right? And then you have your consumer staples, your energy down here, your real estate, etc. But these we have to examine, guys, is this too high? Are you comfortable with 30% of the stock market? I'm sorry, 30% of your S&P 500 being wrapped into IT? If you're cool with it, I'm cool with it. Not a big deal. I get it. But this is something you need to be thinking about as opposed to just saying, oh, S&P 500, no big deal. Set it, forget it. No, you need to be thinking about it a little bit, right? Having these types of conversations where you begin to sort of jog your mind frame in terms of rethinking. Now, listen, in just a couple of minutes, I want to give you some alternatives to just putting all your money in the S&P 500 and letting it roll, right? There's some alternative ways to think about investing where you can even diversify from the diversity that is the S&P 500, right? That's what it's all about. Is kind of spreading your apples, spreading your stuff around, investments around to several different places. As a smart investor, you need to be thinking about these things. If you're holding an S&P 500 index fund or ETF, which I think most people in the chat probably are, right? The deal is simply that the S&P 500 is weighted. And that means large firms carry a significantly more weight than those small market value type companies. That means tech giants, Apple, Microsoft, NVIDIA, Amazon, Alphabet, they're going to have a huge effect on the S&P 500, right? And this is why I asked the question. And this is more than it has been, right? Is the S&P, I think it hasn't had this much weight. These top 10 companies hasn't had this much weight since, again, 2000, 24 years, 25 years, right? And that's why I asked the question, is the S&P 500 becoming too risky of an investment, right? And I know some of you may be saying, no way, are you crazy? And that's okay, because I just want you to be having these thought processes as intelligent investors. As with any investment, there's going to be risk. I don't care how if anybody comes to you with an investment and says there's no risk, we're going to guarantee you a 12%, 15, 20% return, run the other direction and make sure you got your wallet on you when you're running, right? But people rarely talk about the risk that are inherent with the S&P 500, right? And we've seen some interesting things taking place right now. Let me go ahead and stop sharing that. We've seen some interesting things taking place right now in 2024. Started off with a bang. I think right now the S&P 500 is around 8 or 9% year to date. Year to date, meaning from January 1 to right now. But there's some risky things going on. We looked at a few determining factors or two indicators a couple of weeks ago, 3 or 4 weeks ago, that said, hey, things may be a little bit overvalued in the market right now. There may be some stocks that are overvalued, right? But hey, high inflation is being sticky, right? That's one of the most significant issues going on in the stock market right now. Inflation ain't going down. That means interest rates are not going to be lowered anytime soon, right? Because when the Fed goes in and says we're going to lower interest rates, that's an inflationary measure. That's something that normally causes or helps to, I won't say cause, but it kind of spurs or pushes inflation. Because when they lower the rates, the interest rates, people go out and spend. And when people spend, demand goes up and prices go up. So high inflation sticking around is not going to, it's going to mean higher rates sticking around longer, right? So that's an issue that's going on, right? What's the Fed going to do with the Fed funds rate? Big issue. Some of the mega caps that we're talking about, the top 7, the Mag 7, right? One of them just fell out of the Mag 7, Tesla, right? We know Nvidia is killing the game, right? Nvidia is going boom, 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 boom. But are there any other signs of weaknesses for any other companies in the Mag 7, right? Because as I said, the Mag 7 has been carrying us to some of these earlier in the year record gains in the market. The other thing to watch out is consumer confidence, right? Are consumers losing confidence? Because confidence in the market, in the economy, is a strong, strong indicator of what's to come typically for economists. And I'm not an economist, I'm not an expert at any of this, full disclosure, right? I'm just a regular guy trying to help out regular investors. But just last month, consumer confidence went down to its lowest level since in a couple of years, right? Based on studies, reports, surveys, etc. Right? Consumer confidence reached its lowest level in a couple of years since we were close to the pandemic times. So what's that mean? Perhaps that means less spending in the economy. People pulling back a little bit. Now they're having to pull back, right? Because high rates, high interest rates, at some point it has a trickle down effect, what they call a lag effect on the consumers. So we're being a little more protective of our money, right? We've saw in the last few weeks some weakness in corporate earnings reports that came out, right? Not all of them, but some of them came out. Some of the bigger companies came out with some weaker than expected reports, right? But for regular investors, don't let any of these things trip you up. Keep doing what you're doing. Stay calm, carry on, keep going, right? Keep dollar cost averaging. But I think as an investor, we got to know some of this stuff, right? We actually have to say, okay, let me kind of get myself educated. Let me know what's going on, right? So there's some reasons to be cautious, but there's also reasons to be cautious about only having all your chips in the S&P 500. Now, I said I want to give you some alternatives that you can think about doing instead of having all your money wrapped into one S&P 500. And I know most of you don't have that, but some of you do. Let's see here. I'm just going to run back to the chat here. Guys, don't forget, if you're in here, hit that like button for me. Hit that thumbs up for me. And also share the link. If you know somebody that's investing in the stock market and they're trying to learn a little bit about the stock market, they're trying to get more familiar, more comfortable, please share the link to this video with that person so that they can get some of this real basic, plain language information about the stock market, about the S&P 500. Also in the description box, check out my partner on this one, Mint Mobile. I use Mint Mobile, inexpensive, excellent customer service, easy to 15 minutes is what it took me to actually switch over, kept my phone number, etc. But Mint Mobile, check it out in the description box below. Also, if you haven't already, 24 Laws of Money free ebook is in the description box as well. Check that out. And also there's ways you can contact me in the description box, get on my schedule, etc. Because I do one-on-ones with people as well in terms of personal finance. So let's see where we are on the chat. Zach has checked in. Good to have you here. Tesla got my portfolio in the red, said Art of War. Are you hanging on to Tesla right now, Art of War, as an individual stock? Are you hanging on to Tesla? Or did you get out of Tesla? All right. Sounds like you're hanging on. Let's see here. Yes, be diversified. Awareness is important, Kimmy. You're right. Salute to you, Jay Samuels. Good to have you here. Thank you for checking in. Let's see here. Somebody said tech is heavy in all indexes, not just S&P. True that. Jesse James, I buy BRKB in my Roth. Fantastic. Thanks for sharing that information in the chat. My company uses John Hancock for our 401k, so there's not a lot to choose from. Understandable. Everything showing high returns is really expensive on the cost ratio, expense ratios. Yes. Is putting all my money in S&P dumb? No, I'm not going to say it's dumb. House of Craft. It's not dumb at all. but I just need you to be aware of the risk, right? And that's kind of what I'm trying to show you on this in this video. I'm not trying to say that it's not smart. You shouldn't do this. You shouldn't do that. Do this, do that. I'm saying be aware. Have that awareness as a smart investor to say, okay, I got it all in the S&P 500. Cool. But maybe I should think about doing one of these alternatives that Smart Money Bro mentions, or Smart Money Bro. I'm talking about myself in third person that I mentioned, right? You don't have to, but maybe it's something to think about. See, a lot of times with investing, we do it on our own and we don't have any outside input, right? We listen to a few things, but we really don't. We kind of, I like doing it on my own. But I'm just giving you something else to think about, right? Somebody said my 401k is in low cost S&P index. It's 15% per 15.15 cents per $1,000. That's good. That's really good. That's really low cost. Let's see here. Somebody said, hey, from St. Louis, good to have you, Punisher. Clint Perry, thanks for the thumbs up. Good to have you here as well. Art of Horse said, I'm hanging on to everything in my portfolio 5+ years, Tesla included. Okay, I'm not mad at you. You got your strategy. Fantastic. Here's a few things to think about. Here's a few alternatives to just having your money only in the S&P 500, right? First thing is maybe consider an ETF or an index fund that is an equal weighted fund, okay? If you still say, hey, I want to put all my money in the US companies, but I want a little more balanced exposure to some of the small firms, the small cap, and some of the mid cap, right? Instead of having all my money in the 500 large cap, I want to have exposure to other size companies, right? Excuse me. You can consider what's called an equally weighted fund, right? So that could be an S&P 500 ETF or index fund, which holds every stock in the index in equal proportion. So instead of having one basket that has a heavy pumpkin and a heavy watermelon and a really light little grape, right? Instead of having this unequal weighted or this weighted, you can have one where everything is weighted the same. So you have all these different companies, but they all are weighted the same as that one lemon. Not that you have a bunch of lemons in there, right? But don't boom, right? Bad joke. No pun intended. But if you get an equal weighted ETF fund, you're still invested in good companies, but you have more exposure to the smaller size companies and the mid-size company instead of just having it all in these large companies only, right? That means that you might listen. Here's the disclosure, full disclosure. If you get an equal weighted ETF, you may have more exposure to companies that haven't already done well, right? Meaning that you'll be depending less on the high performance of some of those top 20 and top 25 companies, right? But another thing you'd have is lower exposure to tech. Right now, what do we say? 30% of the S&P is the tech sector. But if you go with an equal weighted ETF or equal weighted index fund, then you're not going to have that exposure to tech. You're going to have less exposure to tech, but you're going to have more exposure to, some energy and some real estate and things like that. Right. So the equal weighted S&P 500 index funds and ETFs, they have a higher exposure to the real economy, so to speak. Right? So you got to do your research. That's an option for you. Okay? Some folks like to have S&P weighted, S&P non-weighted. Right? There's overlap there, we know, right? But of course, you have sort of I'll let you do your research. I don't want to dig too deep in the details. The second thing is another alternative to having all your money or most of your money in an S&P 500 is there's nothing wrong with international, right? Go global, so to speak, right? I got you. U.S. companies are profitable and they serve the world economy. And me personally, I like having something like Apple and Nvidia because I know they're no, not Nvidia, but Apple is an American-based company. But guess what? It's also has exposure because it does business all around the world. So that could be your exposure to international if you want, but you don't have to. You can buy international ETFs and index funds, right? Maybe there's less expensive prices for the internationals, right? Something to think about. International stocks are out there as well, and they are available to you. Just because you live in America doesn't mean you only have to invest in only American stuff, right? So that's another alternative. Go global, get some international ETFs. Another possible alternative is one of the things I really like, right? Is maybe you want to go for more value ETFs and value index funds, right? We have, growth ETFs or growth index funds that are looking at those companies that are fast growing but then we have value ETFs, right? They may not be as attractive as the other ones, but, there's nothing wrong with value ETFs. They primarily invest in companies or stocks that are usually trading below their actual what they call their intrinsic worth, right? But they usually have low PE ratios. It's a low price, low expenses, low fees to own them, and they tend to hold companies. If you invest in a value ETF or a value index fund, it's going to have companies in that bucket that are low PEs, low ratios, low expenses, and they typically come with a little bit higher dividend, right? But they're not expected to have that fast growth that growth ETFs are going to have. Slow growth. Value ETFs can be a choice for you. If you're looking for some diversification, maybe there's a volatile market, value ETFs are like this. They're like this. They don't do all this jumping up and down like a lot of other ETFs may do, right? And you get stable returns from stable dividends, right? Over a long stretch. Value ETFs, value index funds, those are things you want to hold for a long time. Real steady companies are in those buckets, right? Stability from value ETFs, right? A history of paying good dividends over a long stretch of time. That's another alternative to the S&P 500, right? And here's another one. Maybe you can go with smaller cap ETFs to balance out the large cap ETF that you have, right? I think I mentioned it earlier, but the ETF that's a S&P 500 is a large cap, right? By default, it's got the largest 500 companies by market capitalization. But then there's all these small companies and medium companies that are out there. Go get some of those ETFs as well and add it to your portfolio, right? Small and mid caps especially small cap, they get no play. They receive no attention, right? No, they haven't done what large caps have done over the last you look at the graphs, 5 and 10 years. But if you look at the 30-year graphs, small cap has done pretty well, right? Small cap is going to be a little less profitable to you, right? Because these small companies, they don't have some of the stability, right? And there's a little bit more risk involved with small cap ETFs and index funds, right? But it's an alternative to give you a little more exposure to other parts of the economy as opposed to just large companies, right? Something to think about, right? Or here's another one. Here's another alternative. Total market index funds. Something to think about as well. So this is why I asked the question, is the S&P 500 becoming too risky? It's a great investment. Don't get me wrong, right? It's a great investment. But you have to understand that you have alternatives. Just because 5 or 10 years ago, when you jumped in the stock market, you read a few things and some people said, just buy an S&P 500, just buy an S&P 500, doesn't mean you have to stay there. As you become more seasoned, you learn more, you understand more, you can start to venture out and add some other different types of index funds and ETFs to your portfolio to give you a little bit more exposure to other areas. I hope that makes sense, guys. Let me go back to the chat real quick. Let's see. Somebody said they just dumped their Tesla on the last upswing. Somebody's got the FX, AIX, and SCHD. I think those are total markets or the S&P 500. Not sure. Let's see. Somebody said, I'm scared we should all buy CDs and convert all funds to cash and HYSAs and hope the SY. Listen, don't be scared. Don't be nervous. This video is not to scare anybody. I know the title said urgent, but it's just urgent because I want you to understand this about the S&P 500. There's some risk involved. And the amount of market share that the top 10, it's growing, right? It's growing. And right now we said 33% for the top 10. That could be 35% in another couple of years, right? And I think of course, where we are now in the economy is not where we were in 2000, where this whole tech thing was new. There was some uncertainty around it. Now there's no uncertainty around it. So if you're cool with having all your money in IT, that's fine. Let's see. Somebody said VTI, VTSAX. There's a lot of different ones out there, guys. Let me give you a few. Somebody asked a question. What is an example of some equal weighted S&P 500 index funds? There is, let me go into, is Spider one? I don't know if that's equal weighted or not. Let's see here. Boom, boom, boom. I just want to see if I can roll off some ticker symbols. Maybe you guys might know a few as well. RSP is an equal weighted run. I think is that Invesco, RSP. Is SCHD an equal weighted? IWD, I think, is one. That's an iShare. Let's see. There might be some others out there that are equal weighted. Maybe I'm wrong. Let me see if I can just pull some up instead of just asking you guys. Maybe I'll just pull some up, some equal weighted S&P 500 ETFs. ETFs, right? Versus index funds. Yeah, RSP is the one that came up. I think iShares has a few of them as well. iShares has one as well. Without going into too much detail there. Let's see here. I'm going to go back to the chat because I'm going to keep this ball rolling. Stuart Florida's here. Good to have you here. A lot of room for growth in international markets. Jesse James said that. Absolutely. Don't slip on the international market. Let's see here. Somebody said I got in many years ago into Tesla before the split and was up 5,500% at one point. That's huge. You're welcome, Neil. Appreciate it. Listen, I just want to have the conversation, right? The dialogue needs to be opened up. The dialogue needs to be opened up about S&P 500s becoming too risky because they're too top heavy. Too top heavy, too much reliance on Microsoft, Apple, right? Microsoft, Apple. Listen, your Mag 7, Microsoft, Apple, NVIDIA, Amazon, Meta, Google, and now Berkshire Hathaway is in there. I mean, that's like six, Microsoft, Apple, NVIDIA. That's like 5 or 6 in the top 7 that are IT. That's huge. Right? That's huge. That's really, really big, guys. That's a whole lot. Let's see here. Invesco S&P 500 equal weight ETF. Zach, that's out there. Yep. Miss Moore said, do you intend to make any change from your current S&P bucket? Right now, a lot of mine is into my investments with at the federal government, which is a TSP, right? And I'm kind of diversified a little. I have some diversity in there. Everything's not with the C fund, right? A large portion of it is with C, but I'm kind of diversified into other places in that one. Now, my own investments outside of there, I have a good mix, right? I have a good mix. I'm a big fan of VTSAX, right? Which is the total market, right? So when you have a total market fund, you're not so heavy in tech, right? The S&P 500, because it's narrowed down to the 500 big ones, it's heavier in tech than if you have a total market fund that covers the total market. you got more exposure to the small and mid caps. Okay, much more exposure to those. Somebody said, I'm staying in the market, but it's growth and dividends. That's cool. The key is this: as you begin to learn some of this stuff and you learn more and more about your options that are out there in terms of ETFs, index funds, single stocks, you name it, you can begin to start to tailor your your portfolio, right? Your investment portfolio to your own taste, right? Maybe you don't want to be so heavy. Maybe you want to have an S&P 500, but maybe you also want to have some international in terms of an ETF. Maybe there's a certain sector that you like, right? Maybe you know a little bit about the healthcare sector and what's going on with the healthcare sector. Maybe you want to have a healthcare ETF or index fund, right? Maybe you want to have something in the communications in terms of an ETF. Maybe you want to have something in terms of in the utilities or energy that you know something about, right? You can begin to tailor your own personal portfolio to match your ultimate goals and match what you're comfortable with and know about. This is what it's all about. I strongly believe that most people don't really need a financial advisor. I do not believe that I'm of the weird thought. You guys can call me crazy. You can call me what you want to call me, but I believe that with a little bit of study, a little bit of research, a little bit of learning, a little bit of self education, that a lot of people are going to be able to manage and do their own investing and not have to pay that fee to a financial advisor, right? The whole industry. Listen, the whole reason index funds was set up, if you read some Bogle stuff, John Bogle, if you read some of his stuff, the whole industry and the history of index funds, ETF, whatever, the whole industry is set up. When I say industry, the whole industry of financial advisors is set up to be the liaison, the go-between between the market and you. But nowadays, there's so much information available to you that you really don't need that go-between that calls themselves a personal financial advisor, right? I'm not talking down to the person that may be a personal financial advisor in the chat, right? But as the information has become more readily available to all of us, we can start to do things and learn things on our own and kind of act in our own best interest with our own money. Something to think about. That's why I like bringing this type of information and education to you guys and to the world, because if we take the time to really study and learn and understand and restudy and research and so forth, we can be good with our own money. A lot of us, right? If you're smart and bright and you've done this and you've done that in your life and you achieved this and achieved that and you've built this and raised a family, look, you've got enough knowledge and ability to acquire information where you can do a lot of this on your own and you can tailor it to you, right? Not to downplay what financial advisors do. They do a good job at helping you organize things. And hey, I help people with their money too, right? So I'm not downplaying that. I'm just saying that you can do a lot of this on your own is what I'm saying. Hope that makes any sense. So, hey, I'm not going to hold you guys long. I wanted to come on here and give you this quick information because I want you to be thinking about it. Because a lot of folks, again, they're not going to have this conversation. All you're going to see is, oh, the S&P 500 is great. Go ahead and invest in the S&P. Put all your money in there. No big deal. Set it and forget it. Because who? Warren Buffett said that, blah, blah, blah. Nothing wrong with Warren Buffett. Can't take anything away from him, right? Excellent investor. Smart man, right? But we can be more informed investors, and that's what we should be. I'm not telling you to change and get out of the S&P and pull your money out of there and put it other places. No, I'm not telling you that at all. I'm telling you, be a wise, informed investor and understand that every single investment has risk. Even the trusty, good old, blue-blooded American S&P 500 that everybody told you was the best investment of all time, it still has risk. Now, if you came here late, rewind this thing back to the beginning because I went over the issues and problems with the S&P 500, right? And if you are stopping by this channel for the first time, guys, you got to do me a favor and subscribe. But I need everybody in the chat to go ahead and hit the like button, hit the thumbs up, right? I certainly would appreciate that. That helps get the information out to more and more people. And this is basic information that people should hear. Free game, right? Is what we want to talk about, what we want to give people. So don't forget to check out the chat. I'm sorry, check out the description box below. Let's see. Renita said, I manage my investments myself and have for several years, and I've done quite well. Congratulations to you, Renita. See, when you have and somebody helping you with your investments, they typically get a piece, unless there's a flat fee. Otherwise, they get a piece of your, they get a fee from your investment gains, right? The more fee that they get, the less money you got, right? This is why you cut out the middleman if you can. Somebody said, what about REITs? What about REITs? REITs are not a bad investment, not a bad investment at all. If you want to earn a little piece of real estate and you don't want to be turning wrenches and all that good stuff and screening tenants, nothing wrong with a REIT. But just remember, you have to research the REIT. Every REIT ain't built the same, just like every stock is not built the same, right? What does the REIT invest in? Are they investing in shopping malls? Are they investing in warehouses, industrial? Are they investing in strip malls? What are they investing in the REIT? Understand it, right? And is that REIT going to be affected by the next commercial real estate downturn that's coming, right? What's that going to mean for your return on investment for that REIT? Got to be thinking about that, doing your research, do your due diligence whenever you invest in REITs or anything else. Let's see. No financial advisors managing my money, said Kimmy. I have a friend who wants to know how to get out of advisors they may have inherited. You got to read the fine line, talk to that advisor about how to do it. I built my portfolio on some individual stocks as well as ETFs and index funds, said Pamela. How you doing, Pamela? 85% of my portfolio is set up with dividend earning stocks and funds. Excellent. Nothing wrong with dividend stocks or dividend funds. I like VYM from Vanguard. I'm a Vanguard investor, so I like VYM. Let's see. The worst thing you can do is to think that it's free money. It's never free money. Yep, you're right. Let's see here. So with that said, guys, I'm going to let you go. I appreciate you being here more than you know. I thank you, thank you, thank you, thank you. Can't thank you all enough for being a part of this live stream, for being a part of this channel, for being a part of this community that we're trying to build to help each other. I also appreciate the chat and the information you all are sharing in the chat with each other, right? Because, I mean, that's what it's all about. People helping people, right? And I appreciate you guys doing that for each other in the chat. Your experiences, the index funds, ETFs that you like, that you enjoy. What is your style? What is not your style? Just putting all that information for other people to see is really, really important. So I really appreciate you guys being active members and talking in the chat, because it helps people learn. And that's what this channel is all about, is helping other people learn. Hey, I appreciate it, Neil. Said, glad to watch your growth. Keep up the great work. Thank you so much. I'm going to keep trying. Thanks, Kimmy. I appreciate you being here. Chris Miller, Pamela, Deidre, Zach, Grayson, Grayman, Kimmy, Neil, Dama69, What Should Matter, sorry, Art of War. I appreciate all you guys coming in here. Mrs. Moore, thank you so much for being here. I appreciate you guys being here. I'm going to let you go. Don't forget this, guys. Watch this. We just put out a video today on YouTube. Check out that video as well. It's called 10 high-income skills that you can learn for free. Share that one as well. At any age, age not a factor. Check that out in the description box and share that as well. I appreciate you guys. As I always say, share the video. And the best person who's going to take care of the old you is the young you. Take care of yourself and take care of other people. Until the next video, peace.